2-year low, and they offer dividend yields of close to 5%, and I think the assets are attractive. So we do see opportunities in some of the bigger, more integrated oil producers. In terms of company that we look at, I think we are particularly favorable in terms of Exxon, as well as CNOOC in Hong Kong. So these are two companies where we feel that they have strong fundamentals and the ability to manage low prices.
Standard Chartered Bank also favours the big players who are involved in all aspects of the oil and gas industry, from exploration to production, refining and distribution.
We do prefer integrated oil majors for now, given their stronger balance sheets, and they are also leveraged to any improvements in oil price in the very short term.
Here in Singapore, OSK-DMG likes the shallow water players. The research house says 90% of the world's oil is produced onshore and in shallow water. It also notes that shallow water operations incur lower costs than deep water operations. So lower oil prices are not hurting the bottom lines of shallow water players. OSK-DMG's top picks are Ezion, Nam Chong and Gikan Sakata. It also likes Pacific Radiance and Marco Polo Marine. DBS likes Pacific Radiance and Ezion. Other market watchers say even shallow water players will eventually feel the heat if falling oil prices persist.
Some of them have fairly strong demands in book orders, but really, I think I would say in the longer term, given the low oil prices, it will be challenging as well for them, and they will be affected too.
Already, it's becoming more challenging to operate in shallow waters. Pacific Radiance says the difficult conditions should last for the next year and a half.
We do see some delays in projects. Petrobras, in their initial plan, was projecting about $90 to $100 oil. But given this situation now, they're revising their forecast based on $70 oil. And there could be some delays in projects. But regardless, we actually see delays or any reduction as a temporary slowdown, not so much of a fundamental change in the viability of the fields or the fundamentals of the offshore oil and gas business.
The company is able to keep costs under control because it builds its vessels at yards in China. OSK-DMG says this can yield cost savings of up to 40%.
But we don't have the overheads of a shipbuilding yard, right? We don't have the pressure to continue building when it no longer makes sense to build. So this model actually gives us the flexibility to scale up when we want to build aggressively, and possibly to moderate our new building plans in times like this, right? When we decide to say, let's be a little more careful, more prudent in our spending, we can actually decide to build less or even build nothing without having the overheads of shipbuilding yard. So this model actually allows us to acquire our assets in a more cost-effective manner, and that actually gives us a lower break-even.
Within the oil and gas space in Singapore, rig builders, Keppel Corp and Sembcorp Marine, have also attracted much attention. The two are among the biggest oil rig builders in the world. Weak rig orders are raising concerns of an oversupply situation.
The performance of the rig builders is highly dependent on the investments going into, by oil majors going into buying and refurbishment of new rigs. At this point in time, the sentiment towards oil-related investment is actually quite negative given where oil price is currently. So we do expect some of the rig builders may continue to be in a range-bound sort of a trading mode until we see a more sustained pick-up in oil prices and followed by oil-related investment.
Shares of Keppel Corp are down more than 20% from a year ago. The company recently secured a $100 million order for a land rig and a $700 million conversion order for a liquefied natural gas vessel, indicating that it is much more than just a builder of deep-sea oil rigs. Shares of Sembcorp Marine have lost close to 30% from a year ago. Low oil prices may be hurting the oil and gas counters, but they are a boon for the aviation sector. Jet fuel is a big expense for airlines.
The a lot of airlines do hedge their fuel consumption or needs for the year. As such, any impact in terms of earnings flow through may probably come up with a lag effect. If oil price continue to sustain at where it is currently at $50 per barrel, we will see a more significant flow through to airlines probably 6 months down the road in terms of earnings.
UOB Kay Hian has upgraded Singapore Airlines to buy, saying it has much more flexibility to hedge fuel than its peers. The brokerage adds that SIA can hedge up to 60% of its fuel requirements for a financial year. Still, there are some who prefer not to put their money on the airlines.
Aviation actually, from our experience, have very difficult economics in terms of its ability to control the cost. And of course, I think because of the fierce competition, it's extremely difficult for airlines to raise prices. The capital expenditure is huge for airlines. It's an extremely difficult industry to be able to generate the kind of return.
Other beneficiaries of falling oil prices include the shipping, transport and consumer staples and discretionary sectors. Coming up, what are you most worried about in today's